Is Stuart McPhee, and it's my pleasure to be with you here today on this Monday, the 6th of June, wherever you are listening around the world. It's great to have your company. If you wouldn't mind just entertaining me a little bit, I'd love to hear where you're tuning in from at the moment. I live in Melbourne, Australia. It's Monday evening here now, but I'd love to hear in the messages, just throw me a quick message of where you are listening, whether it be in Australia somewhere, throughout Asia, or perhaps across to Europe. If you want to just let me know where you're listening in, that would be great. I'd love to hear from you. The other thing is I'll be doing several of these sessions throughout the month of June, not just on Mondays, but also Wednesdays as well. So I'll be back again here in 48 hours time, and also next week, Monday and Wednesday, and the following week as well throughout the month of June. So I look forward to seeing you in those sessions as well. And the other thing, if you don't want to share with me where you are currently tuning in, I'd certainly love to hear what you're currently trading, what you are interested in the markets at the moment. I have several things I want to show you today, just some currency pairs and some indices. But if you have something specifically you'd like me to have a look at, I'd be more than happy to have a look at those charts for you. So just a reminder, I'll be here throughout the month of June. And the way I'll run these sessions is I will certainly provide a bit of education. I do have a small PowerPoint presentation prepared for this session now. We'll just run through a few things, and then we'll get into some charts and look at some real live charts and just share with you some of the ways that I look at those charts. You know, what I thought was really, really important is if you are going to, if you've listened to other people present before, listen to someone last month, the month before, next month, if you go somewhere live and listen to someone present and talk about trading, and you're there because you want to learn a little bit more and develop your own trading plan and strategy and confidence and the right psychology to trade well, excuse me, I think it's important you know where they're coming from. I think it's important you know their trading experience, the way they look at the market. I think it's only fair that you hear that, because not just because someone says it doesn't mean you need to take it as that's the truth and that's the way it is. I think when you listen to someone like myself, someone last month, next month, it's important you gather as much information as you can, as much sort of beliefs as you can, and form your own opinions. Make your own conclusions and make your own decisions on what you think is going to work for you in the market. As I try to impress upon people very much, a lot, is the fact that it's your money at risk, not mine. And not the person who spoke last month. It's your money. So you're the one that has to have that confidence, with your money at risk in the market, and that you have that confidence that, you can manage risk and have the right mindset and what have you. So what I thought I'd share with you now to start this presentation are my core trading beliefs, things that I believe are very, very true in the market. Again, take these as you see fit. Do your own research, do your own homework on this, adopt these as your own beliefs or completely dismiss them. That's completely up to you. But the first one I have here is that trading is a process. And what I mean by that is trading should be, I don't know why that's flicking forward there. Trading should be a logical sequence. It should be a step-by-step process that you follow. That's the second one, but I'll talk about that in just a moment. You know what? I might as well just throw them all out there. There you go. Seeing they want to come out. Trading as a process is the first one. I think trading done well is done as in a logical, step-by-step sequence that you follow through. Now, in one of the other sessions this month, I'm actually going to run you through what I believe is a very, very well-structured, logical step-by-step sequence for you to follow. And don't know why that's flicking forward, but and I'll share that with you. And again, it's a framework for you to follow, for you to put in the bits and pieces about how we enter trades and how we get out of trades and how we manage the risk and all those sorts of things. So I'm going to share that with you in another session. But I think trading done well is done as a process, very, very methodical, very systems-based, very following rules. Very following rules is really, really important. Aim for consistency. I really believe trading done well is doing the same thing over and over and over again. What I mean by that is having the same set of rules that you apply in the market with great objectivity and very clinically. And again, I'm happy to share with you a few more thoughts on that in other sessions this month. And that is the importance of doing the same thing over and over and over again. Now, brokers don't like me saying this, and it's interesting that I'm representing a broker tonight, but I believe good trading, I believe in less is more. I believe in trading less is better for you and better for your trading results. Now, I also believe that that's counterintuitive. It doesn't make a lot of sense, and I'll tell you why. Because when people start trading, they think, well, the only way I can make money from trading is to put on trades, or actually execute trades, enter trades. And I think intuitively we believe that the more trades we put on, the more opportunities we give ourselves to make money, right? In other words, we need to be putting on lots of trades. Open that one, and have 10 trades open because we're putting all our money at risk and we're giving ourselves more opportunity to make money. And I think that's quite intuitive to think that. And I think it's counterintuitive to think that trading less is better for you, but I really, really strongly believe that. I think trading less helps you. I'm sorry, I don't know what's happening with my PowerPoint tonight, but please forgive me and I'll do my best to work around it. But I really do believe people think that the more I trade, the more opportunities I have to make money. That sort of makes sense on the surface, but I also believe for your trading health, trading less is better for you. I also believe in data-driven decisions. Having data, price information drive your decision-making. I think that's very, very important. As a technical analyst, which I am, that's very much a part of what I do, is having that data, that price information drive my decision-making. So as a technical analyst and as a rules-based trader and very methodical in the way I approach the market, that's all data-driven. And what we're trying to achieve by having data-driven decision-making is to remove as much as we can that emotion from our decision-making. And I think if you've traded for any period of time, you'll appreciate that emotions have very little role to play in your decision-making when it comes to trading. And when you do make decisions, purely on emotion, and we could talk about this for a great length, normally good things don't happen. So I'm a big believer in data-driven decisions. I also believe that your best trades will take time. So those trades that actually deliver you the best profit, they don't happen overnight. Trading profits don't deliver themselves to you that quickly, and the best trades take time. Now, the reason why I say this as well is because we need to be prepared to be able to see a trade out, to have that patience, to have that exit strategy absolutely crystal clear in our mind, but also have the patience to see that trade through to completion to ensure that we actually do get as much profit as we can out of that trade. And we look back and go, that was the best trade I've had in the last 12 months. But the only reason why it was your best trade is because you had all those other things working for you. You had the discipline, you had the patience to see that trade through. And that's the real key. So your best trades take time. Don't get out of them too soon. Let your trading plan do its job. And again, that's something we can talk about at great length another time. The second last one is don't use things in isolation. When I refer to things, I refer to technical analysis tools, whether they be a single chart pattern, whether they be a candlestick pattern, whether it be a moving average, whether it be another technical indicator. I really don't believe in using one thing in isolation to help with your trading decisions. What I do believe is weight of evidence. And what I believe is putting as many accompanying tools together, whether they be volatility-based, trend-based, looking at a chart pattern, looking at support and resistance, looking at the most recent candlestick, looking at the most recent reversal pattern, putting these things together to establish weight of evidence. Because all we're looking for with any form of analysis, whether it be technical analysis, fundamental analysis, whatever it might be, all we're looking for is probability. That's all we're looking for. We're looking for trying to find high probability trading opportunities. That's what we're trying to do. And I think that's best found by accompanying different tools together to establish that weight of evidence. And finally, and certainly not last, and this might be my number one core trading belief, and that is keep it simple. Again, I think this is counterintuitive, it doesn't make a lot of sense. And I'll tell you why. Because when people start trading, certainly in my case, I thought trading would be relatively straightforward and easy, and I soon realized it wasn't. And when I realized it wasn't, I thought that I needed to develop a complicated, complex solution to have any chance of being successful. And so then we try to work out, try to develop this most intricate, complex entry setup or entry strategy for our trading, which makes it difficult to implement, et cetera, et cetera. I really believe in simplicity. Simple approaches can work. They can be really, really effective, and they can also be very easy on you and simple to implement. Trading isn't easy, but it should be simple. I don't think trading is easy, but I think you should keep it simple, and I think simple and ease are very different things. But they're my core trading beliefs. Trading is a process. Certainly aim for consistency. Trading less is better for you. And just one note on that, I want you to demand higher quality signals rather than quantity of signals, right? Quality over quantity. Have data drive your decision-making. The best trades will take time. Don't use things in isolation, and keep it simple. This slide now is here, the one that's been trying to get in for a long time now. And all I wanted to share with you here is the whole idea of having a trading plan. And somebody who thinks they can trade well over an extended period of time, and I don't mean just this week, I mean over a course of 6 months, 1 year, 5 years, 10 years. If you think you can do that without a trading plan, I have no idea what you base it on. I think that is one of the most nonsensical, silly ideas that anyone would talk about when it comes to trading. I really believe it's imperative that you develop a trading plan that is right for you, suits your personality, and then you implement that with the right mindset, with the right discipline, with the right patience, with confidence, and all those other character attributes that I talk about when I present and talk about trading. It is really, really key that you develop a trading plan that's right for you. Your trading plan should encompass those 3 areas on the right. That is your money management, managing risk, your methodology, which is your trading system, how you get into trades, and then the most important part that keeps it all together is right up here, and that's the psychology, and that's the mindset. They're the 3 M's that we need to have working for us in order to develop a trading plan that's going to work for us, not just tomorrow, not just next week, but consistently over an extended period of time. When we put that trading plan together, and that's another process, and I'm happy to talk in another session about how we can put that trading plan together. But when we do put that trading plan together and we put it into action and we start to review trades, these are the key performance numbers we should be trying to get in working to our advantage. At the end of the day, we're trying to make money. We're trying to get profit. These are the key performance numbers that we need to keep on top of. These are the key performance numbers that I should be able to ask any trader and tell me, what's your winning strike rate over the last 12 months? What's your losing strike rate over the last 12 months? What's your average profit? What's your average loss? Traders should know these numbers. It's as simple as that. Traders should know their key performance numbers. You should know your winning strike rate. You should know your losing strike rate. You should have a rough idea of your average profit and your average loss. And there's a simple formula to ensure that we are going to make money from our trading system. People refer to it as expectancy, expected profit, et cetera, et cetera. But the key is we need to know these numbers. We need to be on top of them and know exactly what our numbers are for our trading. And it might even be through back testing, and we'll talk about back testing another time, but that we get some idea of these key performance numbers. And finally, what I was going to share with you before we go and look at some live charts is, as I mentioned, I am a technical analyst. It's not the only way to look for trading opportunities. It is simply an approach, right? It's just an approach to analysing trading opportunities. It is far from perfect, far from perfect. It can be very effective. I know it can, and I know of many people who have used technical analysis to great effect, but it's certainly not perfect. It's far from it. But again, remember, all we're trying to do with any form of analysis is try to identify high probability trading opportunities. Technical analysis can be very complicated and mathematical, can be very complex. If you throw in a whole lot of technical indicators, it can be made very, very complicated, very mathematical, and very complex. But I also believe in simplicity and keeping it simple. Remember, all we're trying to do is increase the chance of a profitable trade. And as I mentioned in one of my core trading beliefs, I really want you to be consistent in what you do with your technical analysis and looking for trading opportunities. But let's go and have a look at some charts. But when I talk about increased chance of profitable trade, we're going to have a look at some charts now. And we'll look at a few during this session. But just for the purposes of what I was getting at with the, all we're trying to do is increase the chance of a profitable trade. All we're trying to do is increase that chance or probability. Any form of analysis and any trader, when you think about at the most basic level, all we're trying to do is look at this right-hand edge of the screen right here. All we're trying to do is answer the question, what is most likely to happen next? That's all we're trying to do. What is most likely to happen next? And I'm going to be perfectly open with you. And I've been doing this a long time. And when I mean a long time, I mean more than 25 years. There are times when I look at a chart, and I'm not saying this is one of them right now, but there are times, I'm going to be very open. There are times when I look at a chart and I simply don't have an answer to the question of what is most likely to happen next. And the reason why I share that with you is because I don't want you to have too high an expectation on yourself that when you learn technical analysis and you're learning a whole lot of things about trends and support and resistance and chart patterns and indicators and candlesticks and the like, I don't want you to have an expectation that every single chart you look at, you should be able to determine what is most likely to happen next. I think that is impossible. I also don't hear too many people owning up to that, but I'm going to own up to you right now. It's sometimes impossible to try to work out what is most likely to happen. And that could be for a whole lot of reasons. There could be there could just be no logic, no pattern, no obvious trend. It could just be going sideways for 3 months, 3 weeks. There's just no clear direction. There's no obvious support and resistance. There's just a whole bunch of seemingly random candlesticks, therefore providing you no indication of what is most likely to happen next. And when that happens, you need to move to the next chart, because what that's saying to you is just no trading opportunity based on your set of rules that you look to implement every time you open up a trade. So that means next trade. You move on to the next chart. You move on to this and look at it again tomorrow or next week. But I'm just owning up that it's just unrealistic to think that every single time you look at a chart, you should be able to determine what's most likely to happen. I think that's impossible. But anyway, that's just my opinion, and you may not agree with me and others may not, but I actually strongly believe that. But all we're trying to do is work out what's most likely to happen next. That's all we're trying to do. So whilst we're on the euro, we'll have a quick look at this. And this, this is a daily chart. And I should admit again also that whenever I look at currencies, I always look at daily charts. Always. Most won't. They'll look at shorter time frames. And I have another little education piece I'd like to share with you in another session about how you best find the chart periodicity that is best for your trading style. So in other words, whether you use a 4-hourly chart, 1-hour chart, 30-minute daily chart, I have a very simple technique to help you best determine the most suitable chart periodicity for your trading style. And I'll share that with you in another session because it's really important, because one of the things I don't want you to do is just go through every single chart periodicity. In other words, go look at a 1-minute chart looking for trading opportunities, go and look at a 5-minute chart, 15, 30, 1 hour, 4 hour, 1 day, looking for trading opportunities in the one currency pair. I think it's a horrible way to trade, because the way you trade a 1-minute chart is completely different to the way you would trade a daily chart. And here you are trying to cover the complete range of periodicities and trading styles, and that's next to impossible, especially when you have limited trading experience. But just coming back to the daily chart, the euro, this is euro US. I always just refer to it as a euro in a clear downtrend. Clear downtrend, cannot argue. So we're looking up here now near 117, 118, not quite 12 months ago, but around sort of 10 months ago. And then really through their daily chart, it did sort of consolidate a little bit through here around the 1 what's that, 112, 113 sort of level, did consolidate for more than a month, but certainly in the last few months since Feb, very, very clear downtrend. And if we just look more recently, just over the course of the last few weeks, and we've seen it rally really, really well from really quite low levels. If we zoom out, we'll see that we're talking about multi-year lows here, where the euro was just recently. And sure enough, in the last 1, 2, 3 weeks, the euro has rallied really quite well, and rallied from 103 all the way back up to sort of 107, 108 level, just shy of 108, and it's done really, really quite well. But when you think about it, this potentially is a repeat of what we saw here, just back here in March, when it fell sharply, had that rally back up here, and we're thinking, oh, look, this is a 1 month high. It's probably going to get back into this consolidation zone right here and maybe consolidate a little bit before maybe break higher again. But it didn't do that. It actually fell twice, 3 times as much as it, in fact, rallied in the month prior to that fall. And now we're seeing it do it again. But if you look more importantly, what's it done in the last 2 weeks? It hasn't been able to sustain that rally. And in fact, it's got up to this sort of 108 level right around here, maybe a little bit shy of 108, 107.50 if I was to throw a line in there right around the 107.50 level. Make sure that is in fact right on 107.50. And you can see the amount of resistance that in fact the euro has met at that level in the last 2 weeks. And it's quite significant when you think the amount of money going through this currency pair. Last check, it's certainly the most popular currency pair in existence. So there's a lot of money going through this currency pair. And to think that for 4 days in a row, it smashed up against 107.50 and just couldn't get beyond that level. It did it again, fell away, had another run, finally poked its head above there, but very quickly got reversed. And for the last 4 days, just smashed its head up against that 107.50, unable to break through. Just clear resistance at that level. But again, there is obviously a glut of supply at that level. But again, if you think about the amount of money going through this currency pair, there is a tremendous amount of force, sitting at 107.50, just keeping a lid, keeping a lot of downward pressure on this, wanting to rally any higher. So there's a couple of things working against the euro right now. Look, for those looking to go long, certainly over the more medium term, one is the existing downtrend that's been in existence for almost 10 months, with the exception of this sideways move here, but certainly over the last 4 months been in a very strong downtrend. And this potentially could be a repeat of this rally here. It's not much longer than that rally, and then it got smashed. It's had another little run here, but more importantly, it's just met this glut of supply here at 107.50 and unable to break through. So therefore, I wouldn't be at all surprised if I saw a nice little sort of big red candlestick through here, falling through this 2-week low here, and then continuing back down to retest this multi-year low here, the support level. And, could it get down to parity? Could it get down to 1? Well, of course, it could get down there. More than likely to be a significant support level. If it get down to that, it's a very, very round number, which would be very obvious in people's minds. But certainly, if you've missed this rally, is it actually going to continue to break through that level? Well, it would have to take a lot of force for it to break through that resistance level there, because it's really keeping a lot of downward pressure on price. We'll have a look at the ASX 200. Excuse me, again, just zoom out. I always like to zoom out to gain perspective. So here's the COVID pandemic announcement, like all indices, and it's had a pretty good rally back up. But the interesting thing about this, there's a few indices which haven't done this. A lot have mirrored what the ASX 200 has done, in the last 10 months since the euro has fallen, that sort of same period of time. And what we're seeing here is a very narrow range. It doesn't look very narrow because we're talking about hundreds of points. But if you think in terms of values, up here is around, 7,600, I think I wrote down before, 7,600. I could put that line right around there at 7,600 or thereabouts. It's around there somewhere. I will get it exact for you. And probably down here to around 7,100, that sort of level. So what's that? 500 points, 600 points on a 7,000 plus index. You're looking at 6 or 7%, 8% max. That's it. And that's the range. No more than 8%. And that's the extremes. So for someone to be able to trade short here and then long here and short here and long here, well, obviously you need to be highly skilled and probably taking significant risk to be able to, trade those extreme levels. Certainly back right-hand edge of screen, right-hand edge there when it's been rallying up, reached an all-time high. Why would you be going short right there? So you miss out on that opportunity. But if it was to get back to this level, similar here, meeting resistance and falling away, yeah, you could probably trade that short. But again, the range hasn't been extreme. We're talking about 7 or 8% max. Sure, you can leverage that up, obviously with appropriate risk management in place. But really, this has probably frustrated a lot of people. We're not very far away from where we were 12 months ago, right? And that frustrates people. And if it hasn't doubled and then halved and everything and moved in between that time, and we are now where we were 12 months ago, it obviously frustrates a lot of people. It denies people trading opportunities. And remember, what we want here is trading opportunities. We are traders, and that's exactly what we want. We want trading opportunities. I'm just going to have a quick look at the Australian dollar as well. And just zooming in a little bit here. This equally, I think I've got it here with a few lines on it. This equally has been a little bit frustrating. 0.7, 70 US cents is a clear support level. It was smashed through with really quite a lot of effort, a lot of pizzazz here. Significant reversal here, and then another real smash. Tried to rally back up and get back up through that 0.7 level, and a classic reversal signal here. Great hammerhead, tweezer, whatever you like to call that candlestick. It's a classic reversal, and then continue to fall lower. Retested the 7.7 level again, was able to get back up through. But obviously 0.7 is a key level, 0.75 is a key level. But again, we're sort of just moving back and forth between this range. And it hasn't been precise either. It hasn't been just back up to the top and then back down again and then back up again. There's obviously been a few little where it's only got halfway and so forth. But right now you'd have to think, just based on patterns, just based on what has happened before, that, well, really there's two choices. Either it's going to, see this resistance back here around 72.50, where it met a lot of resistance back here previously and fell back to 70 again. And that's right at that level again now. So it wouldn't be at all surprised if it actually fell over and headed back to that 0.7 level. Again, found a bit of support there. Or it may be in a position to retest that 7.5 level. But again, look at all the resistance here. Sitting right on 0.75, just can't get through there. There is a glut of supply pushing down on that level and really making it difficult to get beyond that level. So, yeah, again, like the ASX 200, I think the euro has moved well. I just think the ASX 200, the Australian dollar, just put on average true range here for a second, just to get a feel for its volatility. So, just adding a little bit of frustration on the daily charts on those more medium-term sort of pictures. You can see the volatility of the Australian dollar for an extended period of time, maintaining probably around 50, 60, 70 pips, 50 to 70 pips per day average. It's not a lot, but it stayed there for quite some time. And just in the last few months or so, we've seen that volatility, and more so in the last month or so, we've really seen that spike to double its normal range. So what's that, 113 pips? So now we're looking at more than double that 50 pips, which has been the standard, 50 to 70, and we're looking at nearly double that. So clearly the move of late has been massive amount of volatility. That, of course, lends itself to greater risk because it's just a lot more movement. So you just need to be mindful of that. And things like this, and again, I can talk about this in another session, that you need to track volatility because, as I said, I think it's directly related to risk. And if you want to trade well, you really need to manage risk well. And certainly volatility is a part of that, and understanding, the currency pair you're about to get into and what its volatility profile is like, whether it's normal, whether it's growing, whether it's decreasing. I mean, at the moment, it is certainly decreasing, but it certainly did have a bit of a spike back here, that is for sure. Well, that's probably it for tonight, today. Just a quick session overview of a few of my core trading beliefs. I just wanted to introduce a little bit of the way I view the market. I look at daily charts with currencies. We can talk a little bit more indices and some commodities and what have you in other sessions. I'm more than happy to do that. I've got obviously several sessions with you all this month. But the core trading beliefs to me are really, really important because it gets you into my mind and the way I look at the markets, and have for more than 2 decades now, and what my core trading beliefs are. So again, you either dismiss those or you review them and consider to adopt them yourself as core trading beliefs. Well, as I mentioned right from the outset, great to have your company. It's certainly my pleasure to be here. Thanks to Eightcap for the invitation and the opportunity to present to you. Remember, Mondays and Wednesdays throughout the month of June, I'll be here to do a little bit more education, talking about developing a plan that you'll have some confidence in, going through some live charts, reviewing the ones we've done, and hopefully you can join me in another session again this month. And if so, I look forward to seeing you. Thanks for your time.